Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. First, I want to say congratulations to Kevin. He subscribed to our channel and commented and is going to be going home with this sweet EBITDA hat. Now remember, if you want access to this swag, it's super easy. We're doing a swag giveaway all month. All you have to do is subscribe wherever you're listening and leave us a comment. Okay, on this episode, we've got David Barr on the show. He's of the PenderFund. He has been a small cap warrior since 2009, and that is no small feat because this is an extremely volatile sector. He tells us what it takes to endure sometimes multi-year winters in the small cap space, and as always, leaves us with his 3 best small cap ideas. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. We all want to make the most of our investments. That's why BMO InvestorLine is here. Their easy-to-use platform packed with tools, resources, and commission-free trading on over 100 popular ETFs can help you trade with confidence and take control of your financial future. Learn how you can earn up to $3,500 cash back when you open a new account at bmo.com/online investing. David Barr of the PenderFund, thank you so much for joining me.
Thank you, Amber.
So you are a small cap investor. You've been doing this since 2009. And I feel like there are gluttons for punishment and then there are small cap investors. This is a very challenging landscape.
It certainly isn't like the easy path through the investing world. I mean, particularly since about 2018, we've seen just an exodus of small cap, and it makes sense. You look at the kind of the what's worked for a long time. It's, S&P 500, it's the NASDAQ, and people are always looking at the trailing 1, 3, and 5 year numbers and trying to get those historical returns. So we've just seen people, both individual investors, institutional investors, leaving the small cap space. So it's been a headwind. It's kind of but that's what makes the job a lot more interesting.
I feel like that's putting it generously because so much of the last couple of years, I've really just talked about 7 stocks, right? The Magnificent 7. So for you as somebody who's looking for opportunities, not even the S&P 493, right? You're looking for names that people haven't even heard of. Like, why do you stay in this space? What gets you excited about this space?
At the end of the day, it's all about finding great businesses. So for us in the small cap space, there's not a lot of investor activity right now, but we can identify businesses that we think, the internal economics, that business is going to continue to compound and grow at, 15 to 25, even 30% year over year. So when you can find those businesses, the portfolio is going to experience the returns of the business.
Let's talk about the secret sauce of small cap investing because, anybody can look at Apple's balance sheet. It's really hard, to have an edge on Apple. But when you're talking about small cap companies like 50 million and trying to figure out how do they get to 100 million and even larger than that, you've been doing this a long time, venture capital since 2000. What is that secret sauce? What does it take to be a good small cap investor?
Yeah, you have to have a higher degree of risk tolerance, but you also need to know the business better. So, my history in venture capital, when you're investing in a private company, you're making a decision that's going to last for 10, 12, 15 years. And you can't just wake up the next morning and sell the stock, right? You're stuck in it. So the level of conviction you need to get to, the depth you need to understand the business at, it drives a much different level of due diligence where you're out there, you're talking to the customers of the company. So you're asking like, why are these customers really buying this stock or buying this product? And when it becomes when it's really compelling for the customer, when you can understand the margin profile, the product the business is selling, and if you think they have a management team that can continue to scale up that business as they exploit the market opportunity, then you're probably onto something.
You gotta love management, I imagine, if you're going to invest in this sector and in this space.
When we make an investment, it's always we believe management has the ability to execute. The reality is a lot of times when these businesses are growing so quickly, a CEO who can take a business from 1 million to 30 or 50 or 100 million can't can't grow the skill set quickly enough to be the same person to take it from 100 to 500. And a lot of CEOs, they're product people. They get super passionate about solving a customer need, and they put all their time and energy into that. And when you get into the details of what's the incremental margin and which sales geography, I mean, they just get bored. I mean, they're passionate idea people.
So do you weed those out?
We're usually investing in that founder. Because that's really where we think a lot of the value creation is when you get that initial product market fit and the business is doing 10 to 50 million of revenue and has that unbridled growth because it's a new market. Customers are just coming out of the weeds, buying the new product before competition and maturity of the business steps in.
So, I'm curious how long it takes for you from when you start researching a stock to when you buy the stock, because that's a lot of things that you have to do in between.
Yeah, and it depends on where the company's at in terms of maturity. A more mature $2 billion software company where there's 15 years of public filings, we can get up to speed pretty quickly on something like that. An earlier stage business doing 30, 40 million of revenue. A lot of times we'll meet with management several times over the course of years before we get the comfort level we need. And it comes back to your first question, talking about management teams. If you've got that long public track record with conference calls and you can understand, management says they're going to do X, do they actually deliver on it? And you can judge that over a long period of time with public filings. In more junior companies, we sit down with management, we ask them, what are you going to do in the next 3 years? And then we start holding them to that benchmark. So it allows us to identify the management teams that actually, have a vision and can deliver on what they think they're going to do.
Have you ever gone full activist, or do you view your role as kind of a vocal shareholder?
Definitely trying to be a vocal shareholder. When we buy a position in a company, it's because we believe in the management team and the opportunity. The reality is building businesses is hard. So a lot of times, issues will creep in and then we will become more vocal shareholders.
Let's double click on that point that you made about since 2018, there's just been kind of a starvation of the sector. And I want to really unearth what is driving that. Some of it is fund flows, but why are the flows leaving, right? There are reasons. Some have lamented about kind of the excavation of financing companies, small cap brokerages. There's fewer and fewer of them. There's also, we could talk about innovation in Canada. There's a whole list that we could go through. What's on your list of why it's like this?
Well, I think you just turned this into a 2-hour podcast. There's a lot of structural issues that have come into play. You kind of talked about the lack of smaller firms, and I think what we've seen in Canada is we've got a bank oligopoly that drives up the regulatory burden, which makes it a lot more challenging for smaller firms to be successful. And equally, as the bank dealers have their financial advisor teams have become bigger and bigger, and they've restricted what they can do. So, I would have met with an advisor in 2009, 2011, who would run their own small cap portfolio. Now, big bank says you're not allowed to buy these stocks. They're on the restricted list. So they can't do it. So we've eliminated that participant from the Canadian small cap market. Equally on the institutional side, we've seen such a proliferation of private equity where if you're an institutional investor, you don't like perceived volatility of mark to market that the public markets provides. We've seen private equity allocations roll up to over 50% of these institutional investors now. So it's just, it's multi-pronged on the reasons why capital has been leaving the small cap space. And
this reminds me that when you're making these investments, there's a ton of small caps in mining, in junior oil and gas. Do you play there at all?
We don't really. We're more focused on technology and healthcare. When we're hunting.
So that's even more ignored because you could have a hope and a prayer as a small cap junior mining, right? Because there's a dedicated audience for that. Yeah. But this area of the market, even more orphaned.
Yeah, I mean, there's 4 or 5 phone calls and we all know who each other are that actually traffic in these names. There is a wonderful individual investor base. I talked to several individual investors who have RRSPs that would make you blush with the size of them. and they are very thoughtful investors, and they're looking at a lot of these similar companies as well. But it's, we're definitely not the majority of people out there today.
Is that the opportunity, though? The fact that since nobody's looking, it allows for a lot of dislocations, and you end up, if you do it right, you can buy companies for on the cheap.
100%. So it's all about capital cycles. So when capital's scarce, multiples contract, and the opportunity set becomes, it's like, in small cap right now, it's like shooting fish in a barrel. It's not needle in a haystack time, which would be like trying to find pick your top 10 S&P 500 stock right now.
But it doesn't also cut both ways, like, because there is that kind of the dearth of buyers. If they miss a quarter, we've seen this. These stocks can implode. They can drop 25%, 30%. Is that just what's the word? Price of admission if you're playing in small caps?
Yeah, well, I think there's actually another factor at play here, and it's the rise of social media and the proliferation of opinions. And like social media is very much out there. I mean, these large firms have hired like behavioral psychologists to trigger dopamine pathways to get people to react intensely one way or another. And so now, if you think of how
these social media platforms,
yeah. So then when it translates into the news cycle as well, where you got some journalists out there are compensated on market moving articles. And so, you get a stock that comes out with a news release, and the message is amplified, which actually creates more opportunity if you believe volatility is opportunity, which we certainly do. So it creates both the dearth of investors today, but then the proliferation of social media and the polarization. It just makes, when volatility occurs, it's even more dramatic than it has been historically.
That's interesting investor perspective on journalists getting paid for market moving stuff. As a journalist, I always thought it was like, yes, that's the way it should be, because then you're adding value, but it has a consequence in the markets, because then what's that quote? Show me the incentive and I'll show you the outcome.
Yeah.
Because then it is on purpose looking for that volatile event.
Absolutely. And volatility, that gets attention. And volatility is super exciting. Either, when things are just getting, like, everybody loves to talk about the stock that got taken out to the woodshed and, cast shade on everybody. And then, but similarly, people always want to talk about their home runs and, how you can make this much money if you just held on.
How do you think about macro? Do you think about it at all? Because you're so granular on the ground, something like tariffs, that can weigh an entire sector. People can just punt out a whole sector because of tariffs.
If you would ask me this question a decade ago, I would have answered it differently. Our process has evolved. Macro is playing a large piece in the volatility of markets and so what individual securities are priced at. And I think with active management today, you need to be a lot more nimble and trade around this volatility, which macro drives. So you need to understand what's going out there in the macro environment to understand where securities are getting mispriced, both on the upside and on the downside.
All right, well, let's talk about some of these stocks and some of these companies that you've gotten to know and dip into the mailbag. Okay, our first question in the mailbag is about a company called Thinkific. What is Thinkific in 5 years? Is it a scalable platform or a niche software business? This one coming from Sultan on X.
Well, I think Thinkific is trying to figure that out themselves right now. It's a wonderful business. It's a content creator platform that allows creators to monetize their educational content online. It was originally the founder, talked about founder-led companies. He built an LSAT prep program and couldn't find a software platform to actually put it online. So he built it himself. And then after building this platform, he figured, hey, this is a great platform where other creators can put their content online. What we really like about this business today, we are shareholders. They've transitioned from small individual creators. They're moving up market into the business segment with their Thinkific Plus platform. And we think this platform can grow at 30% year over year. We think it's a better business than the individual creators, which can be, your customer acquisition costs can be quite high. churn can be very high. In the business segment, it's much more predictable. Net retention's higher. Growth can be more predictable. So we wouldn't be surprised to see this company be twice as big in 5 years and have the majority of its revenue be from the Business Plus segment.
So let's spend a beat on it. It was one of those 2021 IPO stories. And like many of those stories that are still public, at least, that haven't been taken out, it is way off of where it was. I'm curious, when did you get in? And what is the catalyst for inflection? Because when it came to market, it was growing sales at like 80%. And now it's forecasted to grow sales at 9%. So It seems like it's not really experiencing that growth. They came to the market when there was a frenzy, and they have a lot of work to do to kind of win back or earn back shareholders.
Yeah. So I think we started buying after the IPO, after the stock had come off quite a bit. I mean, the majority of our position we built around $2 a share. I think stock had about $1.60 a share of cash at that point in time. So we were basically getting the business for free. When we look at the IPO, I mean, it was coming through COVID, which they just had a huge customer bump. I mean, everybody was at home. Like, so many creators were going online. So it was a perfect storm for their revenue growth. What we've seen since then, and in that period of time, everybody kind of extrapolated, hey, we're growing at 60 to 80%. We're going to do this for the next decade. And they built out all the infrastructure to support that. Big kudos to this management team. They actually led a restructuring in, I think it was February 2022, well ahead of it being really popular because Mark Zuckerberg did it. But they started to right-size the business very quickly once they realized the dynamics had changed. And
is this, as I mentioned, a lot of these Canadian tech companies that have fallen since 2021, a lot of them just go private, they get taken out. Do you think that happens to Thinkific?
I don't think so. I mean, the CEO owns over 30% of the company. He just voluntarily converted his shares from multiple voting shares into single voting shares, which he didn't have to do, was a great signal to the market that he was continuing to look after shareholders over the long term. So I think if they would have been considering a go private, they probably would have done it before switching the shares out, as well as they did a big SIB a few years ago. So I don't see that being a probability, but it's definitely been flavor of the year for companies to go private at low valuations.
I know. What do you think about that? Do you like that? Have some of your companies been taken out in the portfolio?
I mean, we've been beneficiaries, and almost begrudgingly. Like, we had our largest position, Copperleaf, last year was taken out. It was $12 a share. I mean, it was a good outcome for our shareholders, but we really believed that company was going to probably be a $40 stock in the next 5 to 10 years, and we wanted to hold it for the long term. So, it's our compounding was cut short by the go private. Like that was probably more on the fair value side. I think there's been some pretty egregious ones. We had a fun court case with Altius Royalties Renewables, where we didn't like the process they undertook and took them to court about it. We subsequently lost. But
you were basically fighting, saying you're selling the company for cheap. What was it called?
Altius Renewables.
Okay, and you lost. And so did they go private?
They went private.
But did you have a gain on that still?
We made money.
Okay.
But sometimes you just got to put your hand up and do the right thing, and the process wasn't all that well run.
The TSX is at all-time highs, and I don't really hear much peep about IPOs coming to the market. Like, do you have a sneak peek at the pipeline and whether we could see another round of IPOs?
If you would have asked me 6 months ago, I would have been gearing up thinking that we would have a lot of tech IPOs the back half of this year. There's a lot of wonderful technology businesses in Canada that are well through 100 million of revenue and growing 30% year over year and spitting out tons of cash flow. And these would all be $1 billion plus companies coming into the public domain. I think with the political environment and the volatility we're seeing out there, nobody wants to be first to go public first in uncertain times. So I think everything's on hold for a little bit.
All right, but there is a backlog. That would be exciting to you.
Yes, there's a large backlog.
Okay, let's talk about our next company. It's kind of in that vein. What is Dave's point of view on Lumine Group? This one coming from Common Sense 937 on X. Thank you for the question. Kind of an IPO was a spinoff from Constellation. in 2023, and it's done really well. Disclosure, I own it. So I'd love to know, is it going to go much higher?
Well, if you like Constellation software, you probably should love the spin-outs. When you think about the business model, it's a serial acquirer of software companies. So when you have a smaller capital base, acquiring a bunch of smaller software businesses it's a lot easier than adding to a much larger capital base.
So why, if you were buying a software acquirer anyway, why not just buy Constellation? Like, what's this thing that makes Lumine unique?
Constellation's just so big, and Mark's kind of alluded to it in some of his letters where they might decrease the hurdle rate for large acquisitions. So I think there's the hurdle rate and the internal IRR on Constellation is probably going to be is wonderful, but it's going to be lower than what they could achieve in some of the subsidiaries. So
another way to say that is they can't find deals that move the needle for them because they're too big. But Lumine, there's plenty of deals.
Yeah, I mean, there's a lot of deals for Constellation out there as well. But for Lumine, it's just a smaller capital base. So, if each make 20 acquisitions of $5 million revenue each, it's going to be more impactful for Lumine. And I think that the key is with these aggregators, Mark Leonard has done a wonderful job of building out a process and decentralizing it through the organization. And it's in that process that you need to trust when you're looking at Lumine or some of the other spins.
And investors should be wary of roll-ups, right? Because they work until they stop working. How does Lumine skirt that issue of taking on too much debt, taking on too much leverage?
We've both been in Canadian public markets long enough. We could recite the stories of failed M&A roll-ups.
That's right, yeah.
It's all about the process and discipline, and having an investor-first mentality, which the Constellation Group and Lumine certainly does. It's don't take on too much debt. Don't take on any debt, have a very disciplined process, don't overpay, integrate into your company right away.
Okay, this one I don't know very well. It's our third question. What are Dave's thoughts on Tantalus systems? The ticker on that is GRID, G-R-I-D, on the TSX. This one coming from Arzuni on X. Thank you so much for the question. What does Tantalus do, and do you like it?
Yeah, so Tantalus is a smart grid company. And if you think of the world today, our electricity infrastructure in North America is very dated and needs to be replaced. And it needs to be able to deal with very, very different demands than what we've had historically. We're going to have increasing demand. We're having distributed generation. So people are putting solar panels on their roof, and there's going to be there's all renewables all over the place in conjunction with nuclear and hydro. And then, people have car chargers and all these on-demand electronic devices in behind their meter. So Tantalus has built a next-generation product called the TrueSense Gateway, which is the gateway into the house, which allows utilities to monitor what's going on behind the wall, so in the house, with cogeneration, EV charging. It also allows to measure power quality. So it allows a utility to say, hey, we're having a power quality issue in this part of the grid. We need to roll a truck, as opposed to rolling trucks all over the place and trying to figure out or speculate where the power quality and potential outages may be occurring. So it's for the next generation of the electrical grid. They're first to market. The product itself has a $500 million backlog today. They're in 30 field trials. This is when you have the big electrical product companies like an Itron and whatnot. They don't do our R&D in-house. They tend to buy companies and buy the technology. So this is one I could see, to your point of being taken out. If they're successful with their field trials, I could see this getting taken out in the next 24 months.
Looks like you're the largest shareholder. You own about 16% of the shares outstanding. Was this a 2021 IPO-ish?
It came, yes. I think it was right before 2020.
Right before 2020. Okay, so kind of newish on the scene. It's done very well over the past year. When you talk about grid demand and upgrading the system, it seems like people get really excited about that as it relates to AI. Does a stock like this get caught up in the AI trade? Does it do well regardless of AI spending?
We haven't seen a lot of AI speculation in small cap that's non-concept stocks. So, there's always the companies that are out there with their big ideas and no revenue, and it's a concept at this point in time. And, a lot of the times those valuations can get a little goofy as the stock promoters get a hold of them. What we haven't seen is in kind of the micro small cap space where companies that are affiliated or have an AI-based product, we're not seeing a ton of interest in those yet. I think the investors that kind of are looking at more mature businesses are still trying to figure out what AI is going to mean.
Okay, so you like Tantalus. Obviously, you're a big shareholder. We're going to take a quick break and take some more of your questions right after this. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, we're back with questions for David Barr, but I actually have one because you were just talking about the grid and then some concept stocks. And one concept that is super hot right now is quantum computing. And some of them I think you could call, they certainly have the revenues of a small cap, if not the valuations of a small cap. Do you ever traffic in these quantum names?
I mean, we follow the space. We've had an investment historically in a company called D-Wave. We owned it through our venture portfolio, and they went public with a SPAC a couple years ago in the 2021 height. Unfortunately, we are no longer invested. I think we probably sold our position. I think stock's $14 today. So that was a miss.
That was a miss. So why did you sell it?
When we were looking at it, a company was doing about 10 to 15 million of revenue, and they had a lot of big projects that could potentially come to bear. I think we could have. The company was burning a lot of capital. They needed to refinance, so we were concerned about their ability to refinance. But then, the Reddit crowd got a hold of it. The stock went up to, I think, $8, and they started doing at the money financings, retail, and now it's got a strong balance sheet and ability to execute. And we've always believed in the business. It's a great technology. They've branched into additional quantum technologies. So it's good to see that company be successful.
It's not 14 anymore. It's $16, but. I know
just wait 10 minutes.
Yeah, exactly. The one that got away. Okay, a real question that we did get, not just my curiosity, is on MDA Space. Is MDA Space a real player in the new space race? What are your thoughts on the stock? This one coming from Sandra in Markham.
Yes, I mean we're large shareholders of or it's a large position in our fund. I think there's a fundamental misunderstanding with MDA. MDA's been around since the 80s.
McDonald Detweiler, right, is what it used to be called.
Yeah, and the traditional business, it was a lot of like contract work, and they got into a lot of troubles with both debt loads as well as mispricing contracts. So they were losing money on a lot of things they were delivering. This is now a wonderful technology leading product company. It's debt free today, has a $5 billion backlog. It specializes in both robotics and geointelligence, which is going to be key to the next generation of space investment. So we think they're incredibly well positioned.
It has run up quite a bit, as you mentioned, though it started to consolidate, I guess, at these levels. What kind of upside do you see? Like it's space observation, it's Earth observation, and this seems like a market people are really excited about.
The opportunity here is it's almost based on humanity's imagination at this point, right? It's how quickly are we going to move into space? One of the contracts people have speculated about is Apple's building out a global satellite system so they can intermediate all the cell phone providers, so they can just direct cell phone access for Apple. And so is MDA building into those satellites? We believe they are. And then when we look at the geopolitical landscape, it's low orbit satellite systems are required for a lot of the drone conflict going on around. So with the geopolitical environment, we think high probability of a much increased investment in space.
Our next question, we were just talking about roll-ups. Well, here's one. It's on dentalcorp. Does Dave like dentalcorp? I'm considering buying the stock. This is coming from Christy in Richmond, BC. Thank you, Christy, for your question. Dentalcorp is a roll-up, right? It goes around and it buys dental offices.
Yeah, and they can buy a single dental office or a multi-location office, and it's highly accretive. The single and kind of 2 and 3 clinic operations trade at a low single digit on EBITDA. dentalcorp can acquire it with their purchasing power. They can increase the EBITDA margin right away. They can run the clinics better with technology. They can invest in the clinics. So it's when we look at the fundamentals of the types of roll-ups that are successful, this is like right in the wheelhouse. It's a highly fragmented market. dentalcorp is like a single-digit market share in Canada, and there's lots of owner-operators. And when you look at the demographics of dentists, a lot of are baby boomers. They're going to want to be retiring or exiting their clinics here in the next few years. So we think it's a great opportunity, and they could probably double kind of every 5 years here for the next couple of years.
The street loves it. Out of the 10 analysts that cover it, 10 rated a buy, but it's still trading at half of what it was at the peak in 2021.
Yeah, well, of course the street loves it. When you're growing by acquisition, you raise capital through both debt and equity, so there's a lot of fees for the sell side. So no surprise, there's a lot of analysts there. The buy side doesn't love this. The company has had a lot of missteps. They probably did an ill-advised secondary recently. They had a higher debt level. They've had a failed strategic review. But despite all that, these are the opportunities where you look through the hair a little bit and you can find a very attractively priced business. We look at this and we think private equity comes along and buys this for $15 per share minimum all day long. So right now you're sitting there, you can double your money. If the business grows, it doubles every 5 years. This is a really potential for a really nice rate of return over the next 5 years.
Yeah, trading at $8 right now, ticker DNTL. So maybe people want to do their homework on that one. Our last question in the mailbag is about goeasy. I feel like if you're a small cap investor in Canada, you have to know about goeasy. I've been following this stock. On the venture, says Eugene in Kirkland, Quebec, it has a small float, rather impressive performance. I'm hesitant to jump in due to the nature of the business. Can you please comment on goeasy? And the nature of the business, of course, is financing.
Yeah. Well, Eugene, I think you've nailed why the stock is trading at an attractive valuation. As a business, the economics are phenomenal. Management's done a great job of building that business, diversifying it. So we think it's a very robust specialty finance company here in Canada. The reality is that it trades at a discount to what it's worth because of the business they're in. There's just not a lot of institutional investors that actually will own it. So
they provide loans.
Yes.
They provide loans for home furnishing, major electronics in your home. And so obviously, if you're concerned about the Canadian economy and credit quality, this might not be a name that you flock to. And we see a bunch of other companies that get put in the penalty box just because people don't like the space or the Canadian economy right now. So let's peel back the layers and look at the fundamentals of goeasy, even if there is economic softening.
When we look at goeasy, we don't own it, but they've done a great job of historically their book was traditionally subprime, so it was very, very high interest to people who couldn't get credit elsewhere. They've improved the quality of their book over time, and now a substantial part of their business is actually prime. So lending that banks may take on if they were actually in the spaces that goeasy is in. So they've improved the quality, which is absolutely what you should be doing in robust environments like we've had over the last decade to prepare yourself for the downturns. To your point,
but why don't you own it then?
We just don't. We don't like the business model.
Okay.
Yeah.
All right. So you don't like it either. We're going to take a quick break. We're going to find out what David does like in Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first pro pick, I'm not super familiar with this, so I'd love a backstory on Kraken Robotics. It sounds like a concept stock.
Well, the initial concept was fantastic. It was Some people wanted to go find sunken Spanish galleons with a bunch of gold on them. So they were treasure hunters. And so they built a technology so that they could actually go treasure hunting with drones in the ocean. To do so, they needed to build out underwater battery technology and really great sonar technology. So those are the two core products that Kraken offers: is sonar and underwater batteries. And
so originally developed, so it was almost like a hobby.
It was 100% a hobby.
Okay.
It was a very wealthy individual wanted to go find sunken treasure.
And then how does it turn into a business?
They started getting inbound interest from both defense contractors, but also oil and gas and resource exploration companies. So, if for exploring the bottom of the ocean for resources, you're generally doing it with drones. So having an unmanned underwater vehicle. And their battery technology can withstand pressure at incredibly can withstand the pressure at incredible depths, which is the secret sauce of what they do. It's really hard. Everyone's kind of saw.
We learned that from that tragic submarine accident.
Exactly. It's a whole different can of worms when you're operating at depth down there.
So you're a big shareholder. It looks like you own under 10%, just under 10% of the company. The ticker is PNG. It's had a huge run. Does it go much higher?
We obviously think so. We continue to hold it, and we're very optimistic on the company. We think the geopolitical landscape. I think what we heard about the Golden Missile Dome yesterday. Defense spending is going to continue to increase, and if you look at how Navy spend is going to move forward, building a submarine for hundreds of millions of dollars that you have to train people on is very expensive. Putting smaller drones out there at a 10th or even a 50th of the cost is the way a lot of these NATO navies are going to go. And they've got a strategic partnership with Anduril, who is, JD Vance is a shareholder. It's the leading kind of new tech U.S. defense contractor down in the States. So when we look at the order book that Kraken's building right now, we have a lot of visibility on continued growth for the business.
Okay, your second one is Dye & Durham, and it should be just a very boring business, legal software. But that's almost like besides the point of what's going on at Dye & Durham, because there has been a very dramatic, what do you call it, like almost a family feud at the company. So can you backstory that for us? And then we can talk about why you like it.
Some people like watching Days of Our Lives. I watch Dye & Durham. I don't know how far we can go back here, but it's obviously
a podcast. We can go far back as you want.
Yeah,
lay it on me.
Matt and Tyler would kill me if I went right back to the beginning. So
these are the brothers that are.
Yeah. So Matt's the CEO. Tyler is a large shareholder of Dye & Durham. These two guys built a great business and generated a ton of economic value, a ton of wealth. They IPO'd. They were the first IPO in 2020. I think they led the whole IPO boom. IPO'd at, I think it was $7. Stock went up to almost $50. And they were able to, they had tremendous access to capital to exercise their M&A strategy. You kind of fast forward to about a year and a half ago, 2 years ago. And, it became evident that a lot of the acquisitions, weren't working out as well as advertised. So there was a group of shareholders, you can read Globe and Mail and read all about it, that just went to speak to the board and said, hey, we think we need a more disciplined capital allocation process here. We probably need to delever the balance sheet a little bit. And Tyler was one of those shareholders voicing that opinion. Matt was
his brother.
To his brother. Matt was of the opposite opinion. And then, nobody agreed. So it ended up with Engine Capital from New York getting into the mix and leading towards the end of last year. They put a dissident slate forward at the annual meeting, and they took over control of the board.
So where does that leave the company now?
Stock's just languishing. It's down $8-9. Matt has, public press release that he wants to buy the company for $20. I kind of ask myself why he does that.
But when a stock is trading at $9, it tells you the market is giving that offer no credibility.
Exactly. So we don't I'm not going to tender my shares to Matt at $20 because I think this business, and the reason Matt wants to do it is he knows private equity would pay $25 plus for this business all day long. And so here we are. With the turmoil, like there's a whole bunch of investors that wouldn't buy the stock because they were concerned about Matt's leadership. And now there's a CEO search going on. Everybody's talking behind closed doors about what's going on with the company. This is fundamentally a really sticky business, generates a ton of free cash flow. We're going to get a new management team in there, and they're going to execute for 3 to 5 years. And we're going to be really happy we talked about it here at $9.
So, you mentioned all that drama, and like the business can be as good as it wants, but if management is busy, with sort of infighting or dealing with proxy battles, and I know that some of that has been put to rest. Did they lose business during this period? Like when you looked at the actual fundamentals, did they remain sound?
The fundamentals have remained sound. There has been a little bit of client churn, and which is normal. I mean, this is a very public battle, and clients they can read the newspaper and social media as easily as the rest of us. So they know what's going on. So yeah, that's why we from our perspective, we don't like to engage in that way. We were pretty quiet in the background throughout this process because these types of these activist campaigns, they are defocusing to management. It can have impact on the customer base. A lot of Canadian activists are really nice and do things behind the scenes, and that's definitely
That's your approach. Okay, you said you don't really invest in commodities, but TerraVest has some energy exposure. It invests in oil services companies. Is that right?
Yeah, so they buy a bunch of companies that bang out steel and produce products for oil and gas and other more traditional markets. Like they build propane tanks. This is just a wonderful business. I think we originally bought it back in 2014. I think our first purchase price was $6.05 a share.
$6.05. Yeah. I'm underlining that because TVK now trades for $167.
Yes, I think this is probably the best performing stock in Canada that nobody knows about. And
so why did it take off like a shot, particularly like in 2023? It's just like it was I'm looking at it. In 2023, it was around, I'm just picking a random point, call it a $30 stock, and now it's $160. Why did it take off?
Yeah, as the market cap, as the company continued to grow, the market cap kind of crossed through the $500 million and $1 billion cap threshold. So it became an idea for a lot of the all cap Canadian managers. And so when it gets to that market cap size, and then you just look at the economics, they've grown their free cash flow per share since 2013 at about 20% annualized. I mean, that makes every single fundamental investor blush and start buying stock. And then when you look at the future, they've done that historically through great capital allocation. And when we're looking forward, we think they have an opportunity pipeline of over about 400 companies. So we think they can double again in 5 years and then double again 10 years out with the opportunity set in front of it.
Their revenue surged as well. So it's not a story where you all of a sudden saw a decline. Was the catalyst of that acquisitions or just kind of finding their stride?
I mean, they'd been hitting their stride for a long time. It was very much getting to that market cap size and then actually going out and talking to the street. Like I remember I'd call up Dustin, the CEO, and he'd be like, Dave, I'll talk to you because you've been a supporter for so long, but I don't like talking to investors. And he does like talking to investors now. But they just didn't talk to anybody, and they were just going about running their business. And if a CEO doesn't really want to talk to me because he knows I'm a waste of time because he wants rather be building his business, I'm not offended. I think that's a wonderful thing.
When we see a stock that is such a runaway hit over a short period of time, my obvious question is, how much more upside is there? You say the business can grow. Does valuation come into play at some point? How do you think about that?
Valuation does come into play. I mean, this was growing. This has started from such a low multiple. Like it's kind of it's still attractively priced range for us right now. So we continue it's a top 5 holding for us. And particularly given the credibility of the management team, their focus on operational results, their discipline on capital allocation, we believe they can actually execute on the M&A and organic growth to double in the next 5 years, which makes this stock very attractively priced.
David, thank you so much for joining me. What an insightful episode.
Thank you, Amber. Always fun.
That's David Barr of the PenderFund. Make sure you join our next episode. We're talking real estate stocks with somebody who's been an investor for a very long time. We've got Dennis Mitchell of Starlight Capital joining us. If you've got questions about REITs, now's your chance. You can email us questions@inthemoneypod.com. Find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.